Hello, my name is Joe Scarice, Mortgage Lending Specialist. I'm here with a guest of mine to discuss investment in commercial real estate math. We have Antonio DiCiani, Commercial and Investment Real Estate Specialist. Antonio, thank you for joining me.
Yeah, thanks for having me, Joe. Good to be here.
So, why did we pick investment in commercial real estate math?
I think it's fundamental, really, to looking at commercial real estate and investment real estate. It starts with understanding the math and the numbers behind every investment. So it's kind of important to understand that aspect first.
So the first question I have is, where does operating metrics come into play when it comes to investment in commercial real estate?
Yeah, so it's they're key. They're key to understanding what's going on with the deal. We break operating metrics down into several aspects so we can really understand what's happening with the transaction. The first being one that I think people are probably most commonly hear is NOI, net operating income, right? It really tells us what kind of cash flow is being generated from a property before you start taking into consideration your debt service and capital expenditures. Something just as simple as taking your rental income and subtracting out your operating expenses. It gives you sort of a baseline for the operations of the property. Another thing we look at after that is cash flow, net cash flow, right? How much money you put in your pocket. Taking that NOI, subtracting out your debt service, any additional capital expenditures, you're getting a good grasp on what kind of money you put in your pocket, how to evaluate the deal. And the last, which kind of ties the two together, really debt service coverage ratios.
Mm-hmm.
If we can look at that and kind of understand how well the property covers, it gives you a really good idea of the cushion, if you will, between your operating revenues and expenses and your outgoing mortgage payments.
So under current market conditions, where does value come into play with the math?
Yeah, it's super important these days, right? We've seen a lot of inflated values, but we're also talking about some depressed opportunities coming up maybe in these next couple months. So it's really important to get a good solid grasp on value. When you're looking at value, you look at a couple different things. I think you look at price per pound, price per unit, right? How much per unit are you paying for an investment? We talk about multifamily, you're talking about anywhere from $50, $60, $75, $120, $150,000 a unit. It really kind of depends on the asset, the location, the condition, the vintage. And then we look at price per square foot. You want to tie it back to what's the replacement cost of that asset. How much would it cost you to build that asset in today's market? It gives you a good gauge for what are you paying for versus what it's actually worth. Mm-hmm. Then the final, which I think everybody kind of knows, or at least has heard about, cap rate. That ties back your value to your net operating income and gives you a good gauge of the general risk return profile.
So why is cash flow metrics so important?
Yeah, it kind of goes back to analyzing the overall deal and what kind of money you're putting in your pocket at the end of the day. And if you have investors, it's a really important thing to look at because that's going to tell you, sort of dictate to you how you can pay out your investors and go through the waterfall. When we talk about the most basic of cash flow measures, we talk about gross rent multiple. This is kind of a common old school method of just evaluating cash flow. You're really talking about your payback period. How long does it take you to get that money back? Which in general is kind of the biggest thing to look at. And cash on cash is certainly important. Also referred to as cash yield. You take your net cash flow divided by your equity. Really important because you want to know what kind of return you're yielding on your equity. Super important thing to look at.
So where does investment metrics come into play?
Yeah, so when we talk about investment metrics, it's kind of like the next step in things. You start with operating, you move down the ladder there to cash flow, right? And then you get to investment metrics. This is kind of particular to your specific structuring of your deals. Really important because it gives you a good gauge of the return, overall return. One of the most important things people look at is the ROI, return on investment. It's kind of your total cost over your total benefit. So it's the gain essentially divided by the total cost of the investment. And then finally, sort of the last two that most people sometimes overlook, but super important, especially when we're talking about value add deals and distressed deals that have a big investment component, turnaround component, is the IRR and equity multiple. We look at IRR because it really gives you a good gauge of the overall return of a deal, factoring in how long it takes you to get that return. So essentially, it's the annualized return on a deal. It ties back timeline and risk return profile. And then your equity multiple is always important too because it brings you back down to a reality. How much money am I actually putting in my pocket? It's essentially how many times am I returning my investment?
This is great information on investment in commercial real estate math. I want to thank you. Thank you for tuning in, and we'll see you again soon. Thank you, Antonio.
Thanks, Joe.
You're welcome.